Only 0.88% of day traders are consistently profitable over time. That's not a typo, less than 1%. While everyone else is chasing quick profits, the vast majority are actually losing money faster than they can make it. Today, we're diving into day trading for absolute beginners, what it actually is, why the statistics are so brutal, and the essential knowledge you need before risking a single dollar. By the end of this episode, you'll understand whether day trading is right for you and exactly what it takes to be in that tiny percentage who succeed. Let me bring in someone who can break this down from the ground up and give us the real story behind those shocking numbers.
Those statistics you mentioned are from research tracking over 450,000 traders on the Taiwan Stock Exchange. And here's what's really sobering. A Brazilian study of futures traders found that 97% lost money, with only 1.1% earning more than minimum wage.
Wait, so we're talking about a 97% failure rate? That's almost everyone.
Exactly. And broker disclosures commonly report that roughly 70 to 90% of retail accounts using leveraged products lose money. But before we scare everyone away, let's define what day trading actually is. Day trading means buying and selling investments quickly, often in less than a day, to profit from short-term price movements. According to NerdWallet, it's about capturing profits from small price changes before the closing bell.
So we're talking about holding positions for hours, maybe minutes, not months or years like traditional investing?
Exactly. Day traders open and close multiple positions in a session to generate profits from short-term market movements. Importantly, positions are not normally held overnight to avoid overnight risks.
That sounds incredibly fast-paced. How is this different from what most people think of as investing?
Great question. Traditional investors focus on fundamentals and accept daily swings. They're betting on whether companies will grow over months or years. Day traders focus on intraday price patterns, order flow, and fast execution. Here's a simple example from the research. At 10:15 a.m., you buy 200 shares of a company for $50.25. The price reaches $51.1 by 11:45 a.m. You sell and make $170 before fees. That's day trading.
So $170 profit in about an hour and a half. That actually sounds pretty appealing when you put it like that.
And that's exactly the trap. Day trading is often marketed as a get-rich-quick scheme, but it requires serious commitment in both time and capital. The reality is much harsher than those success stories suggests.
Right, because we're back to those brutal statistics. What makes it so difficult that 97% of people lose money?
Several factors. First, day trading is high risk because it involves frequent, fast-paced trades in volatile markets where small price movements can lead to significant losses. Many strategies also use leverage to make small price moves meaningful.
Leverage, that's borrowing money to trade with, right? That sounds like it could amplify losses just as much as gains.
Exactly right. Leverage makes wins larger and losses faster. That's why risk management becomes absolutely essential. According to the research, most profitable traders risk no more than 1 to 2% of their account per trade.
Only 1 to 2% per trade? That seems really conservative for something that's supposed to generate quick profits.
And that's the key insight most beginners miss. Risk management is the foundation of day trading. It's like the foundation of a house. Without it, anything built upon it is likely to crumble. Here's a golden rule. No one has a crystal ball that can predict the future. No trader can control how much profit they make, but they can control how much they're willing to lose.
So it's more about limiting downside than maximizing upside?
Precisely. There's actually a real example in the research. A trader bought a stock at $49 and it quickly flushed down to $39. Without proper risk management, they could have lost almost $10,000. But with a stop loss at $45, they only lost $1,000.
That's a huge difference. So what does someone actually need to get started with day trading?
According to NerdWallet, the first step is opening a brokerage account, which can be done in about 15 minutes. But that's just the technical requirement. The real preparation is much more involved.
What kind of preparation are we talking about?
The research suggests a structured approach. There's actually a complete beginner's guide that takes you through 30 structured lessons in 4 stages, from basics to setup, to rules to psychology. Each lesson is about 15 minutes.
Psychology? That's interesting. I wouldn't have thought of trading as a psychological challenge.
It's huge. The research identifies 6 essential traits for successful day traders: discipline, patience, and others that separate winners from losers. Emotional decision-making and rapid trading can lead to impulsive decisions and poor trades.
So you need the right mindset before you even think about strategies or technical analysis?
Absolutely. But let's talk about the technical side too. Day traders need to understand supply and demand zones, support and resistance levels, and chart patterns like breakouts and breakdowns.
That sounds pretty complex. Can you break down what support and resistance actually mean?
Sure. Support levels are spots where buyers step in at lower prices, causing the stock to bounce. Resistance levels are where sellers step in at higher prices. You'll notice prices hit the same spots and bounce multiple times.
So it's like finding patterns in how stocks move up and down?
Exactly. The research suggests looking for extreme highs and lows, those mountain-like peaks and deep valleys. The more often a price level has been tested, the stronger it is, because buyers or sellers keep showing up at those points.
This is starting to sound like it requires a lot of screen time and analysis. How much time does day trading actually take?
The research breaks down a pro trader's real schedule into 4 essential time blocks. Day trading requires intense focus and time, which can actually lead to burnout. It's not a passive activity.
And what about the money side? How much capital do you actually need to start?
This varies by country. In the US, there's something called the pattern day trader rule. If you make 4 or more day trades in 5 business days, you must keep at least $25,000 in equity.
$25,000? That's a pretty high barrier to entry.
It is, though FINRA approved rule changes in September 2025 that may eliminate this requirement, pending SEC approval. But here's something interesting. In the UK, there's no minimum capital requirement and no pattern day trading rule.
So it's easier to get started in the UK from a regulatory standpoint?
From a capital requirement perspective, yes. Day trading is legal in the UK when conducted through FCA-regulated brokers. There's no limit on the number of trades per day, though you still need to follow UK tax rules on trading profits.
What about choosing a broker? The research mentioned several platforms.
NerdWallet rates several platforms highly. Charles Schwab gets 4.8 out of 5 for desktop customization, E-Trade gets 4.5 for educational resources, and Fidelity gets a perfect 5 for access to investing data.
Those all sound like established traditional brokers. What about newer platforms like Robinhood?
Robinhood gets 4.5 out of 5 and is noted as best for 24-hour trading. But the research emphasizes that the best platforms offer low margin rates, fast execution, research access, low costs, and robust mobile apps.
You know, there's something that's been bugging me. With all these risks and low success rates, why do people keep trying day trading?
The research identifies several motivations. Some are attracted by the idea of quick returns, others by flexible hours or the thrill of watching markets move live. But here's the thing, day trading is possible, it's just really hard.
And I imagine social media and success stories make it look easier than it actually is.
Absolutely. The FCA actually regulates day trading partly to prevent misleading marketing and unrealistic profit claims. They want to protect retail investors from fraud and scams.
So if someone is still interested after hearing all this, what would be the responsible way to start?
The research strongly recommends starting with paper trading, practicing with fake money to refine strategies before trading with real money. Only risk money you can afford to lose and develop a clear trading plan.
Paper trading, so you can learn without the financial risk?
Exactly. And here's something most people don't realize. Successful day traders treat it like a serious business. They're disciplined, educated, and they follow strict rules. It's not gambling or guessing.
That makes sense. The research mentioned that the stock market rewards structure, discipline, and understanding, not guessing.
Right. And as markets evolve in 2026, traders face faster momentum, algorithm-driven volatility, and shorter reaction windows. The traders who succeed are executing repeatable, high-probability strategies.
So when you step back from all this, what's the real takeaway for someone considering day trading?
The brutal honesty is that most people will lose money. But that small percentage who succeed aren't just lucky, they've put in the work to understand risk management, technical analysis, and market psychology.
And they've accepted that survival is the first goal, not getting rich quick.
Exactly. If you're going to try this, start with education, practice with paper trading, use only money you can afford to lose, and be prepared for a steep learning curve. Most importantly, don't quit your day job.
That's probably the most important advice of all. Remember those statistics we started with? 0.88% consistently profitable? That's not a game, that's a harsh reality check.
If you're still curious about day trading after this episode, start with education, not money. Learn the basics, understand the risks, and practice extensively before risking real capital.